We've always heard that sometimes one should take a contrarian approach to investing. By contrarian, basically what one means is to look at sectors which are out of favor currently in the market and to also focus on sectors which are currently in favor and therefore heavily in the portfolio of investors. Now, why is it important to be contrarian? The first and most important reason is to basically recognize that most industries are cyclical in nature. They go through good times and they go through bad times. When stocks are out of favor, they're usually going through a cyclical downturn, which also implies that at the end of that downturn, the stocks will move up once again. And therefore, smart long-term investors must always keep an eye on sectors and stocks where there is complete pessimism in the market and very low ownership. The two benefits of being contrarian, primary benefits are A, that it usually ends up in bringing your overall portfolio valuation down. Because when you buy fancied sectors which are in favor, you're essentially buying stocks at much higher P multiples. And when you buy stocks which are out of favor or under-owned sectors, you're buying stocks at much lower P multiples compared to their historical standards. And therefore, by owning them or some of them, you bring down the overall valuation level of your portfolio. And B, it de-risks you from owning very highly owned, popular, fancied stocks, because at some point, these stocks and sectors will also start a correction of their own. And if you own only these stocks, chances are that your portfolio will correct significantly in terms of price. These are the various reasons why it always works to keep some kind of a contrarian approach while looking at your portfolio. The way to be contrarian is to always be alert to certain kind of phenomenon in the market. When you're in the market, you always know which sectors nobody wants to buy. And there are many ways to figure out why and how that is true. One, if you look at mutual funds or you look at individual portfolios of people, the commentary around, it is easy to spot which sectors are not owned by people. A very low of ownership is usually a good sign that this should be on your contrarian radar. The other thing is that the weightage of these sectors which are out of favor actually tend to be very low in the key indices that they belong to. So, for example, right now, if you look at the Nifty and the Sensex, the sectors which have very low weightage are pharmaceuticals, are telecom. These are sectors which are completely out of favor. Now, this is not a case to buy them, but it certainly is a case for them appearing on your contrarian radar, that these are sectors where the weightages have diminished significantly compared to their historical weightages in the index, and therefore one should look at it carefully. Equally importantly, one should look at sectors where the weightages have become very large. And if you look at the height of the IT boom, the IT weightage in the index, Sensex and Nifty, had become disproportionately large. Today, the weightage of financials, banks, is disproportionately large. And that should be a contrarian warning bell that at some point there is a risk of an accident. So both for expensive and popular sectors and for inexpensive and under-owned and under-liked sectors, these are the usual ways to spot whether a sector should come into your contrarian radar. This is a common mistake. When people think of contrarian investing, they often say that they should shun what other people are buying or what is popular choice of sectors completely. That is not always true. You will find that at any point in time, a certain kind of stocks always find their way into most smart portfolios or long-term portfolios. One reason could be that some sectors in this country are fairly secular in nature and not so cyclical. So some of these private banks, consumption kind of stories, they're not that deeply cyclical as some other sectors like maybe metals or autos or chemicals, those kind of sectors. And therefore, one should make a certain allowance for more secular nature where growth has been consistent for a very long period of time. It's not necessary that those sectors being popular means that you should throw them out of your portfolio. But having said that, one should be very careful of actually only owning stocks which are very popular in nature. The thing to keep in mind is that even the crowd is right for some length of time. So if the crowd owns something, then you can own it. But when the crowd owns a lot of something, you must also recognize that the risks of that sector are going up with every passing quarter. As long as you're cognizant of that risks, it may not be such a bad idea to also participate in some of the sectors and stocks which are owned, which are consensus popular trades.